142!
This is what investing used to look like. Nowadays, it looks something like this. Hi, welcome. My name is George, and today you are going to learn the basics of investing, including why it is important and how to get started, the different asset classes that you can invest in, the financial system. You're going to understand how the financial system works and why it seems to be so complicated. And by the end of this video, you'll probably be way ahead of most beginners out there. Let's dive into the video. Okay, what investing is and why invest in the first place? In its very basic form, investing is the act of putting money into assets with the main idea of generating return. At the very least, you would want your money to maintain purchasing power, and if everything goes right, you will have your money appreciate in value over time. Now, for the sake of this explanation, you need to remember that there are two types of assets: real assets and financial assets. For the sake of this video, you just need to remember that financial assets are nothing more than a claim of ownership over real assets. However, if you want to learn more about this, I will include a link down in the description, which will lead to my personal finance blog, where I discuss this topic in more detail. When investing, you have three different ways to generate a return on your money. By having the assets appreciate in value, that's one. By generating return, if you invest in dividend stocks, this means that you are part of the ownership of a certain company, and the company distributes profit to its investors, one of which is you. And the third way is by generating income by receiving interest payments from a company that you have given a loan to, which essentially is when you invest in bonds. Bonds are debt instruments. When it comes to investing, there are two main principles for you to understand. The first one is the concept of time value of money, and the second one is the risk-return trade-off. The main idea when it comes to time value of money is that money at present is worth more than money in the future. And this is because one of two things. The first thing is that money can actually be invested and generate a return, so you have opportunity cost. And the second idea is this thing called inflation. So when you keep cash, inflation erodes the purchasing power of your money. Essentially, inflation is the general increase in prices of goods and services. And let's say in 2023, you want to buy a pair of headphones and you bought those for £400 or dollars. Let's say if you have levels of inflation 10%, which is not unseen as I'm making of this video. This means that, let's say, a pair of headphones that used to cost $100 or £100 in 1 year time is going to cost 110. So we'll need to generate 10 additional dollars or pounds to get the same pair of headphones. This is one of the essential reasons why invest in the first place. Basically, when you invest, you ideally put your money into a vehicle, the vehicle being your investment, and it goes away, and after time, ideally this vehicle would have protected the purchasing power of your money. Imagine it this way. Now, the second important principle is the risk and return trade-off, and this is essentially the relationship between risk and return, which is higher risk can potentially lead to higher returns and lower risk can potentially lead to lower returns. But the opposite is true as well. Having lower risk, you will have lower potential losses, and having higher risk, you will have higher potential losses. So it's a very, very fine balance, and it's up to each individual investor to decide how much risk they are willing to take. When we think about the financial system, we think about this enormously complicated spider web of relationships between institutions and governments, and it's just overwhelming. But in its core, it's way more simple than that. Essentially, it consists of institutions with the core goal of facilitating the flow of money between borrowers and lenders, between the people that need the money and the people that are willing to lend it. And it's important for you to understand that in the financial system, there are two different types of markets: the money markets and the capital markets. The money markets are the markets that are dealing with the short-term needs of the borrowers, short-term securities, and essentially what we're interested in, which are the capital markets. The capital markets are the markets that shares, bonds, and derivatives get traded. The capital markets are where the long-term investing is happening, and this is what we're going to look at for the rest of the video. Capital markets can be further divided into two, the primary market and the secondary market. And essentially, the primary market is where companies would go to raise capital. And in order to raise capital, they would issue for the first time, this is important, hence the name primary, they will issue for the first time some investment instruments, which might be shares if they want to raise capital by letting go some of the ownership of the company, or they can issue bonds if they want to raise capital by borrowing money from investors. And there it comes the secondary market, for example. The secondary market is where those already issued financial instruments get traded. So for example, the investors from the primary market can get their holdings and sell it to another investors, for example, on the secondary market. Okay, having explained what investing is and how the financial system works and what are the different markets, including like the money markets, the capital markets, and then the primary and secondary market, it's time to go over the different instruments that you can invest in, which are the different asset classes. Okay, let's start with bonds, or the so-called fixed income securities. You probably know already from the previous points, but when you buy bonds, you're lending money to the issuer of the bond, which might be a government or a company, in the exchange of interest payments and your principal, your initial investment when the bond matures or at the maturity date. Bonds are considered to be on the safest side simply because your income is predictable, you know exactly how much your return is going to be, and you get paid before profits get distributed in the company. Let's say you buy a corporate bond, the creditors get paid before the shareholders. The shareholders might not be paid at all if the company decides to reinvest the capital. So this gives a certain level of security, certain security when it comes to predictability of your income from the investment. However, with the lower risk, you get to have lower potential returns, on your bond investment, which is completely in line, by the way, with the risk-return trade-off that we discovered early in the video. Investing in shares, however, is a completely different ballgame. Shares or stocks represent ownership of a company. When you invest in shares, you become shareholder and you get to claim ownership over a company's profits and the company's assets as well. There are two different ways to benefit from your investment in shares. The first one is if your assets appreciate in value over time, and the second one is your assets produce regular payments, and in this case the payments will be in the form of dividends. Dividends, however, are not guaranteed even for dividend paying stocks, because there is no one person on earth that can predict if a company is going to be profitable 1 year or 2 years or 5 years going forward. You can make an educated guess, but you cannot predict for sure. I think for now you can start seeing the difference between bonds and shares, and why shares have significantly higher risk but significantly higher potential return as well, whereas bonds are predictable and low risk, low return type of investment. There is a third type of financial instruments, which are derivatives. And as the name suggests, derivative is a financial instrument which value gets derived from the price of an underlying asset. The underlying asset can be bond, share, or commodity, for example. On the exchanges, you can get two main types of derivatives: options and future contracts. Derivatives are usually used in hedging strategy, used by financial professionals to mitigate the risk, but on the flip side, they can be used for speculation as well. As a beginner investor, I very highly recommend you stay away from those, and I need to warn you specifically for a certain type of derivative called contract for difference. Let's say you as a beginner investor, depending on where in the world you live, more often than not your broker will offer derivatives as option for trading on stocks, and those derivatives will be CFDs, contracts for difference. Trading shares via CFDs as opposed to buying real shares is different by two ways. First, you don't get to own the share, you simply bet on the price movement of the underlying asset. And second, most often those are traded on margin or leverage, which means that you use borrowed funds to control larger exposure, to control larger position. Which can go either way. You can significantly lose or you can significantly win. It essentially acts as magnifying glass for your potential returns, but also for your potential losses. let me tell you, it is extremely easy to lose money by trading CFDs. So as a beginner investor, just for your peace of mind, don't use them. Let's now continue with what I consider to be the easiest and probably the best way for beginner investor to gain exposure to the stock market and start getting returns. We're going to talk about indexes and exchange traded funds, ETFs, which are a way for you to invest in an index. But first thing first, what is an index? Index is a basket of stocks from a particular sector of the economy put together so we can follow the cumulative performance of those stocks. S&P 500, for example, is an index. It's probably one of the most famous indexes in the world. So when you see S&P 500, S&P 500 is the cumulative performance of the 500 largest US companies. Many popular indexes include Russell 2000, Dow Jones Industrial Average. Here in the UK we have FTSE 100, FTSE 250, which are our blue chip and mid-size cap companies respectively. So I'm sure you've heard about indexes, but how do you invest in those? There are three different ways for you to invest in an index. The first one is using derivatives. The second one is putting your money in a mutual index tracking fund. And the third one, which is the widely available option and the best option for all of us, is using exchange traded funds or ETFs. If you want to learn more about ETFs, watch this video here, and I'm going to include a link down below in the description as well. But briefly, I can tell you that exchange traded fund or ETF is, as the name suggests, a fund that is traded on the exchange. Now imagine you have the index like S&P 500, for example, and you put the companies from the index in the exact proportion as they are in the index in a box. You then close the box, you cut it into small pieces, which are shares, each piece represents one share of the box, and you then trade those shares on the exchange, exactly as you would do with regular company shares. This gives opportunity to investors like us, beginners, to gain exposure to the underlying assets, to the assets that are in the box. The potential benefits you get from investing in an ETF is, first, you get to have very well diversified portfolio. Imagine, instead of stock picking individual stocks and having to do the research, etc., you get to put your money in shares that represent the cumulative performance of the 500 best companies in the world. Let's say if you take S&P 500 as an example. Second benefit for investing in ETFs is the low cost. If you invest, for example, in a mutual fund that tracks an index, you will have usually an asset manager that needs to be paid. Since ETFs are run passively, you then save from large amount of fees, and it's way cheaper for you to participate in the market. As a third one, I would say liquidity. Open and closed mutual funds are a completely different topic, but let me tell you, it is but at least significantly harder to get in and out from a mutual fund. Whereas with ETFs, you trade the shares of the ETF on the exchange. So it's made extremely easy for you to be able to go on the market, buy ETF, and then sell it should you need your investment back, should you need to liquidate some of your funds. We've covered a lot of material, a lot of stuff. I really hope you remember. If you haven't, go back at the beginning, watch the video again and again and again until you get your head around the different basic concepts of investing. And I promise you, if you remember those stuff, if you understand them, you will be ahead by a mile from probably 90% of the people out there. I really hope this video brings value. If it does, let me know by clicking the like, subscribing if you haven't, and I will see you in the next one. Well, how the whole fun? No. That was not supposed to happen. Moneyconstructor.com. This is my personal finance blog. It's precious to me. So be gentle.